Chris Gannatti. Since WisdomTree launched the China ex-state-owned Enterprises ETF earlier this month, the Chinese market has really been on a wild ride. So the first thing I want to know is, what's your outlook for Chinese stocks? Is the worst over?
That's a great question in the sense that the markets have certainly been volatile of late. You've seen a lot of the major index providers like MSCI going through the process of consideration, seeing if A shares are ultimately going to be added to the various indexes that they produce. But at the end of the day, when we look at China's market, we see a bifurcation right down the middle. We see some very inexpensive single-digit PE, greater than 5% dividend yield state-owned enterprises like the banks, the energy companies. And then on this other side, we see some of the technology firms, which have certainly been amongst the more volatile, much lower dividend yields, much higher PE ratios. So it's almost like if there existed an option where people could say, look, I want to be the contrarian on China, I want the valuation hunting approach, there's one tool in the toolkit. Or look, I want to be a momentum investor, and I'm excited about the prospects for these entrepreneurial companies. That's another tool.
All right, we'll talk about the CXSE in a second. First, I want to get your view of China slowing, because that's an overlay onto what's going on into this crazy market. So will that just drag down everything because of the slowing GDP?
It's a great point to bring up, Greg, because the way that we think of it, and we've looked at this a lot, and you kind of saw it in Japan in the middle of last year, namely Japan had some negative GDP prints, and people who bought DXJ at WisdomTree were saying, is it over? Negative GDP. Well, the connection between GDP and stock price performance is really tenuous at best, because what people have tended to do over time, when they see the highest GDP, they get euphoric about the market, they bid up the prices, they pay too expensive multiples for the stocks, they get bad returns going forward, and they wonder, I'm seeing a double-digit GDP number, my returns are terrible. And so sometimes the best opportunities aren't necessarily in the fastest GDP growth regions. And additionally, when we look at China, we remain excited about the prospects of the government undergoing that important transition from the investment-led economy to the consumption-led economy. And so long as that transition continues to make incremental progress, we remain optimistic on China, probably in the medium to long term. Admittedly, volatility may persist in the short term.
All right, now let's talk about the CXSE. This is the China ex-state-owned Enterprises ETF. It's light on energy, light on the banks, big on information technology. So talk about the construction of the ETF and why somebody would want to own it right now.
It really, Greg, brings to mind one of the most exciting reasons that I love to get up every day and come to work at WisdomTree, and that's we get to be on the innovative forefront of this whole concept of smart beta. And smart beta, it's an evolving concept. It's not something that's really set in stone, and what it will be years from now, who knows? But what we did in December of last year is we launched a broad-based approach where we took a certain risk, state ownership, and we took it out of the emerging markets. That's XSOE. And what this is, the China-specific variant, namely you take one of the most important markets in emerging markets, one of the largest, and you say, look, there's an important risk factor that seems to be dominant in Chinese financials, Chinese energy, Chinese telecom, Chinese financials, state ownership, exactly as you stated. The main benchmarks, the FTSE index, the MSCI index, they're essentially 70% or more weighted towards state-owned companies. So what we're doing is saying, own China, but don't necessarily own the state-owned companies. We think it's a very exciting new way to own China, and it hasn't existed in the past.
And finally, what about the valuation of some of the Chinese companies in the ETF? You have a lot of ADRs like Alibaba, Baidu, CTRP. These things are pretty pricey, but they're a lot of fun, I guess.
They are a lot of fun, and what we would say is, look, there are definitely two types of China investors today. There's one type, they're the contrarian, they're saying, Chris, take me to where the money is not going, and that's the deep value, state-owned enterprise sector of China. The obvious investment in our toolkit would be something like a DEM, which is going to hunt for the best valuation opportunities. It's 20% weighted to China, and it's buying all the banks, the energy companies, those type of stocks. On the other end, we have the ex-state-owned enterprise fund, and though certain stocks in there may have higher multiples, the overall multiple, which is in the mid-teens, is very close to that of the MSCI, the broader market cap-weighted broad benchmark of the 23 different emerging market countries. So on an overall basis, relative to emerging markets, the index itself in aggregate really isn't that expensive, and we think it's a higher quality way to access some of these exciting names that you spoke of.
All right. Well, thanks a lot, Chris.
Thank you. Pleasure.
And thank you for watching The Street.